Alrighty.
All right. So we should be live. This content of this meeting is being sent to a custom live streaming service. Well, let's see if it's actually working. There we are. Okay. Awesome. Okay. Now, technical challenges, as always. Anywho, today is Tuesday, and it is the 19th of November, which means we're coming up on the end of the year, and this is the $1 Trillion Show. So let me just dive in, actually. I've got a whole thing that I prepared as for what that means, the $1 Trillion Show. All right, so let's jump in here. So this is the $1 Trillion Show with your host, Neal McSpadden. On the line here, we've got Serena, we've got Fatma, two key members of our team. And our goal is to save Americans $1 trillion. Now, that sounds like a lot, and it is. That's about, as of last year, a quarter of the tax revenue that government has raised. We want to make a significant impact on the tax burden of America and Americans. That's the mission. And how we do that is by scaling tax savings strategies through technology. Obviously, we're Tech Sherpa. We have our own clients that we deal with on a one-on-one basis. We have our group, the explorers and the navigators, which we deal with on a one-to basis rather than one-to-one, like our one-on-one ones. But we're not going to get to $1 trillion, we don't have enough time in the day. So how we do that is by scaling technology. Technology takes a lot of forms. So one of the things that I'm working on, in fact, I was working on it earlier today, is things like the starter course. So that's this guy that I've been working on today. The starter plan is what we call the people who can utilize tax strategy, but it's in this in-between phase where it doesn't make sense to pay a full-service firm like us several hundred or sometimes several $1,000s a month to do this work for you, because the net tax savings is not large enough in order to afford that. Because when we work with clients, we're always adding value. We always want people to make multiples of whatever our fees are. And some people, their situation just doesn't work just because of the character of their income or the amount of their income or what they do. So what the starter plan here is for is people in that situation where there are things they can do, but the dollars don't pay in order to hire somebody to do it for them. So that means it's a do-it-yourself kind of scenario. We have the knowledge, and we're going to give people the knowledge of how to do that, along with the templates and the worksheets and everything. As far as if I have a day job and I make $100,000, or I think the median salary right now is like, or something like that, and median households like 78. So if you have that level of income, then you're paying taxes and you have things that you could do. And what the starter plan does is it guides you through those different things and how to set up things correctly, document things correctly, and then take advantage of the tax law so that you can reduce your overall tax burden. And so this is an example of the technology that we can apply to everybody and get the knowledge out there so that people can make their own tax situations better. I'm perfectly happy for people to save $5,000, $7,000, $8,000 a year just by implementing basic stuff in the starter plan. But people don't know what they don't know. We have to go through it and educate people on how to do all those things. So that's how this is all starting to come together in terms of what we do in order to scale those technologies to the wider populace so that we can save $1 trillion, because that's our guiding star, is the mission. I'm the guy that was getting letters saying I owed the IRS $0.3 million. It's funny, every time I tell people that, at this happened today, we recently purchased a firm here locally in Atlanta, and we're in the process of reaching out to clients and telling people about the transition, and we're reviewing their files and all these kinds of things. And I've spoken to one woman today and telling her how I got into the business, and I got into it because I had my own problems. So when you start getting letters from the IRS saying you owe $1 million, but several things start to happen. Thing number one is you go into panic mode. And thing number two is you go into stick your head in the sand mode. And it took me 2 years to start cleaning up my tax issues. And then it took another year to actually fix them all. So this was all a long time ago at this point. And that's how I got into the tax world, through my issues. And ever since then, I've been focused on the strategic side so that we can save our clients, whether it's $1,000 on their taxes a year or $1 million on their taxes a year. And I've done the whole spectrum of that whole thing. And then Every dollar that sits in your pocket and not in the everyone's pocket is a win for me. That's how I come to this. I approach the whole tax world. So yeah, that's the background. With that said, let's jump into, I'll give you a little preview of the starter course. So basically this is do-it-yourself tax planning. And there's a couple pieces that are common ground. So thing number one is everybody in America should have an LLC, which sounds ridiculous, but it's true. And the reason for that is that everybody I talk to, and I've worked on over 50,000 tax returns over the years. And every time I talk to a new client and I start asking them questions, 8% of the time, there is something beneath the surface there, but from a tax perspective that is not being utilized. My favorite question when I talk to people with day jobs is, okay, you go to work and you come home. What do you do when you're not at work? And then I just let them talk. My favorite question, because I hear all kinds of answers. And what I concluded from that is that just about everybody has some kind of side hustle going on if you have a day job. These days, it's easier than ever. You can just sign up on Uber and you can deliver Uber Eats, or you can give people rides or whatever. That kind of super easy stuff did not exist 15 years ago, but everybody's doing something. I've had people, I was in South Florida for the first part of my career, and so it was a lot of South Florida type stuff. So we had people raising snakes. We had people coral in their garages and selling it to saltwater aquarium people. I had one woman who would teach cooking classes, and she'd go to people's houses and teach them how to cook. Just all kinds of stuff. And what's so fascinating to me about that side hustle is that is usually what people are actually passionate about. Yeah, you had your day job. Very few people are super excited about their day job. I am. I actually love what I do, but I've created my day job. I didn't just go to work for somebody else. Most people are at work to make money, and that's it. But the side hustles is where they're really interested in. And that to my own self as well, I've been really interested in regenerative agriculture type stuff for a long time, doing aquaponics and worm bins and all kinds of stuff, but on a hobby level rather than a true business level. But everybody's doing something is the upshot there. And so everybody should formalize that and actually have an LLC to manage this business activity. And 92% of the time, that LLC should elect S corporation treatment. What that means is a couple things. So one is that it files its own tax return. It's not part of your personal tax return. So an S corporation and a partnership and a C corporation, all of those file separate tax returns from the owners. And it's important because it pits different IRS departments against each other, which simplifies your life significantly. And there's some formalities that you have to go through with a corporation. There's a form that you have to file. And the next part is you have to manage your bank account. And in the business, you need a business bank account. Now, we work with Relay Financial. They're fantastic. They have very easy bank accounts. There's no minimum balances and there's no monthly fees, which is the two biggest problems with business bank accounts. And they're nationwide, and it's super easy to set up because you fill out your information. They send you a text on your phone. You take a selfie. You take a picture of driver's license. The whole thing takes 5 minutes to set up, which is fantastic. And then you have to manage your basis. And I don't want to get into a whole thing about what basis is, but basically it's the net investment you have in your company. And that's important if you're taking deductions, especially for you day jobbers out there. And then there's 3 basic strategies that every company should employ, including your own company. So one is an accountable plan, and that's a reimbursement strategy where, if you've ever had a job where you went at a conference and you had to give them receipts so that they can reimburse you, that's an accountable plan. That's just reimbursements for business use of personal funds. And there's a whole series of different things that you are using on the business, but you're spending personal money on. And that training goes through how all that works. And you're able to create reimbursements to yourself that are expenses to the business, but not income to you because they're reimbursing money you've already spent. Health reimbursements, there's different flavors, but basically you want to be taking health expenses at the corporate level rather than at the personal level. Personal level is not as deductible. There's a whole thing as to why that is, but yeah, so you want to get deductions out of your out-of-pocket medical expenses. And summit strategy sessions. So summit strategy sessions are our version of, you might have heard of the Augusta plan or the Augusta strategy. You can rent out your personal dwelling up to 14 times a year, tax-free. And it goes back to 1976 with some rich guys who lived around the golf course. But basically, that's the summary of it. Where people screw it up is in 2 ways. They screw it up because they don't have the right number in terms of how much should that rental cost. And the way to do that is to actually do market research, and we'll show you how to do that. And the second thing is not to be a business purpose. And they just say, oh yeah, so I rented it for business. I had a party or I had a whatever. But it's, oh yeah, the thing that the IRS gets people on most of the time is documentation. So we'll show you how to actually document your meeting and what to actually do during that day so that you have the tax strategy. That's great. But more importantly, you have the process by which you are reviewing your business. And what that does is it actually makes you have a better business over time. It's critical. And then the starter plan diverges if you're a day job or if you're a true small business owner. And there's different considerations in those different groups. So if you have a day job, you're going to be probably running at a loss after everything's all said and done. There's considerations with how much of a loss and how to manage your basis and all this kind of stuff in order to avoid red flags and keep things humming along smoothly. And then if you are a true small business owner, whether you're a freelancer or a 1099 contractor or just an independent person, then there's different considerations there. And we dive into each of those separately. That's the starter plan. Effectively, this is just do-it-yourself basic tax planning. If you're an average, you can typically save yourself $5,000, $8,000, $10,000, something like that every year. So it's definitely worth doing. Now, this kind of thing is one of the resources that is included with our navigators, which is our premium group. For our explorers, it's going to be a small fee, like 20 or $30, something like that. Definitely worth doing and understanding how these different pieces work together in order to keep money in your pocket and not the government's and add to our $1 trillion. At some point, we have to start keeping track of how much each person is saving. That's going to get difficult as we distribute this to the masses. But what do you think? Should people report in? I was going to pay this, but now I'm paying this and figuring out that savings there. Oh yeah, this is technology that we're working on in order to get to our $1 trillion, basically. All right. Enough of the what. Let's dive in. The other thing that we do here every week is questions, because everybody always has questions. Everywhere I go, whenever I say, oh yeah, I do taxes, I help people save money on taxes, it's just nonstop questions forever. But I have the answer. I have the answer to every tax question that there is. And the answer is, it depends. Yeah. And it really does depend. And it depends on facts and circumstances. And what that means is that what is true for your particular situation may or may not be true for somebody else. I spoke to somebody today talking about IVF and the costs involved there. And we're talking about, is that a medical expense or is it not? And what it comes down to is that, is it elective or is it medically necessary, right? And what you have to compare that to is like normal bodily function. So normal bodily function is, yes, people are able to have children. So IVF is actually restorement of a normal bodily function. Therefore, it is medical expense. Now, how you treat that medical expense depends. Depends on your income, depends on whether you're itemizing, depends on if you have company, depends on if you have a company reimbursement situation. All these things depends, but that's what it comes down to. Serena always has a pile of questions for me that we can go through here. Oh, we do have a question on the chat. Serena, do you have the chat open? I don't know if I actually sent you the link or not.
But I don't link.
Yeah, but missed the first 15 minutes. Will this be repeated? But yeah, we do this every week, but it's different every time. But yeah, if you're on the YouTube stream, that they'll keep a copy there and you can rewatch it once the live stream is over. And then as Fatma here does a lot of our video editing, and then it get posted separately later on when it's trimmed up and all that kind of stuff. So yeah, there are ways to review everything. So have no fear. Everything on the internet is recorded forever. All right. Serena, what do we got this week?
So we have someone that wrote and asks, what's the smartest way to handle taxes if you receive an inheritance or a large one-time payment?
Typically is not taxable to the recipient. There can be situations where it is, but it's pretty weird. Inheritance comes in with the estate tax. We might have heard of the death tax. This is an issue with Trump getting reelected. Before Trump got into office the first time, the estate exclusion was about $5 million for a married couple, which is an interesting correlation. But typically the wife lived longer. So husband passes away, leaves less than $5 million to the wife, and then the wife gets a combined exclusion of $10 million. So the Tax Cut and Jobs Act back in 2017 basically doubled that, and plus a little bit more, and raised it to $11 million. It gets adjusted every year for inflation. So I think we're up to 13 at this point. If your estate is less than $13 million, then it's going to be under the estate tax exclusion. Some states have lower exclusions, so you got to watch out for that. I think New Jersey's 2 million, something like that. If it's under the exclusion, the state doesn't pay any tax. If it's over the exclusion, the state does pay tax. but then the recipients of whatever's left after taxes are inheriting that tax-free. Like I said, there can be weird things if you don't do your estate planning correctly. So we had one client that we talked to last week where he's got a company that's been running for decades. He wants to give it to his kids while he's still alive. And he wants them to become more involved and take over ownership. And he wants to gift them shares. And you can do that for sure, but you have problems in that when you gift them, you're gifting them at your basis, which is zero because he started the company. The kids do not benefit from the step up in basis. Laid out all the different options. It's way better if you just get a market valuation and just sell them whatever the shares are. Then they have their cost basis at that new number, and then they could finance it or whatever to spread it out over time. That avoids all those problems where if you got this asset before the person passed away, then there can be tax implications because you're taking their basis rather than your step up basis. So that's a whole issue. The story of large one-time payments depends on what it is. If it's inheritance, then same rules apply. But if it's something else, then yeah, typically you're going to want to run that through a company of some kind because typically that's where one-time payments come from. I guess I'd have to know more about the situation in order to get the more in-depth answer.
I was going to say the same thing.
Yeah.
Bang, dear. So we have another question for real estate and property taxes. Someone wants to know, how does owning a home impact your taxes and what deductions are available for homeowners?
Yeah. Personal houses are deductible slightly. First, you have your real estate taxes. Your real estate taxes are part of your itemized deductions. If you look at Schedule A, the first part is medical, and that's for medical above 7.5% of your income. Second part is state and local taxes. SALT is the way that's shortened. And that's where your property taxes go. That's where your state income taxes go. If you don't have state income taxes because you live in Florida or Texas or whatever, you would put in state sales taxes. Third category is going to be mortgage interest. Mortgage interest for mortgages $750,000 and less in terms of balance. The next category is charitable contributions. And then there's the miscellaneous other for disaster lawsuits or gambling lawsuits or stuff like that. Under the current system, which is the Tax Code and Jobs Act regime, most people are no longer able to itemize, meaning that when you add up all those different things, then the total is less than the standard deduction. So for 2025, they just announced the numbers. For single filers, the standard deductions would be 15 grand. For head of household, I think it's 21. And for married filing joint is 30,000. And married filing separate is 15. Same as basically, your medical above 7.5% of your income, plus your state and local taxes limited to $10,000, plus your deductible mortgage interest, plus your charitable giving, has to add up to be more than those numbers, more than 15,000, more than 21,000, more than 30,000 before they even begin to count. So because of that, most people are not able to itemize unless they have a huge mortgage interest or they have huge charitable giving. And then in bad situations, you have huge medical expenses. So if you talk about your personal home, property taxes and mortgage interest go into that calculation, but because it's hard to itemize overall, you're probably not going to get anything out of that for most people. So for investment property, for a house you don't live in, that's not true. And all expenses are directly deductible against that income from the rent. But for personal property, that's it. Now, the exception to that is that if you have a business that you're running out of your home and you take a portion of your square footage, then you have home office expenses where you can take some of those indirect expenses. And there's ways to do that through home office or business use of the home, which is your Schedule C. I recommend doing it that way. Instead, do it through an accountable plan. Much better, much safer. So in that way, you're able to take a portion of your property tax, a portion of your mortgage interest, a portion of your insurance, a portion of your HOA fees, a portion of your utilities, and those other things are not deductible at all as a personal residence, but are deductible for business use. You just have to do it right. And if you go through the starter plan, show you how to do that. In that way, you're actually able to get some bang for your buck out of the personal property expenses. However, here's where people screw it up. This is all under home office type stuff. And home office has two requirements. Requirement number one is that it has to be regularly used. Now, regular is easy. I do this twice a week, 3 times a month, every day, whatever, it's regular. The second part that people have a lot of trouble with is exclusively. So whatever square footage you designate as your home office has to be exclusively used for office business purposes. And so there have been all kinds of crazy court cases about this. So in one case, a guy was a lawyer, had an office in his house, saw clients in the house, totally legit. He installed a bathroom to be in suite with his office, so he didn't have to go downstairs or whatever. And during a Christmas party that he had at his house, he let people from the party use his office bathroom. And that right there was enough to violate the exclusivity of the usage. And so they threw out this whole deduction. In another case that I think is egregious, there was a woman, she had a baby, and she put a crib in the office, in her home office. And this came up during examination, and they determined, oh, that's personal, it violates the exclusivity, therefore we're throwing out the whole thing. And that's even if you had a regular office, like outside your home, and you put a crib in there, that's still an office, right? Nobody's going to argue about the personal use of that 4 or 5 square feet that the crib takes up. So you got to be careful when you define what your area is. And so one way to deal with that is to define your area very specifically. It doesn't have to be the whole room. In my home office in my home that I was in since COVID up till 2 weeks ago, my office was in my basement, but it wasn't the whole basement. It was about a quarter of the basement. I just applied square footage rules appropriately and deal with it that way. So with the woman with the crib, if she had cut off the square footage that she was counting for home office to cut around the crib, then she would have been fine and it wouldn't have violated the exclusivity. You just got to be careful. And the key guiding words are regular and exclusive, especially exclusive. So those are ways to deal with home expenses. But it sounds like a simple question, but it depends. And it gets into the nitty gritty real quick.
So that is it depends question.
Yeah, that is a
Right.
it depends question for sure.
Looks like we have a tax planning question, Neil. Someone wants to know, is it better to overpay taxes throughout the year and get a refund or aim for breaking even at tax time?
So this is a philosophical question. Okay. So there's 4 scenarios. Scenario number 1, you overpay throughout the year, you get a refund. You effectively have given the government an interest-free loan during the course of the year. Now, personally, I'm not a fan of that. There are situations where it happens and it is what it is, but that's not the goal, right? I've seen a lot of people use their tax refunds as a forced savings account, where I know if I have the money, then I'm just going to spend it on whatever. So I'd rather hold it in the separate place where I can't touch it until once a year. And then I get a big check all at once. And yeah, okay, that has a place that it depends on your personal makeup as far as whether that's a good idea or not. In general, not a fan. Second situation is break even. You kept up to date throughout the year. You've done your projections. You've made sure that come January, which is when quarter 4 is due, you have your numbers for the whole year and you can say, okay, my typical liability is X. Here's the last payment. That brings me up to X. We're even Steven. I just got to file the final returns later on. That's fine. Situation number 3 is where if you typically owe money, then there are quarterly payments that the IRS wants you to make. And there are 2 different ways to do it, 2 basic ways to do it. So one is the even approach, where it's, okay, you go through the year, like we're in November of 24, and we say, okay, the year is looking in March, at the end of March, we're looking at this amount for the year. I make a payment in April. In the end of May, we're looking at this for the year, so I make a payment in June, and then September, and then in January. But method number 2 is based on your prior year tax return. So let's say my total owed last year was $10,000. As long as I pay 11 this year through my quarterly estimates, then I'm not going to be penalized. But that does not mean that I'm going to be even when it comes to time to file taxes. It just means I've paid enough to not get penalized. So because different years are different, right? Especially for small business, can be wildly different. That's the safe harbor approach. And it's okay. I'm not such a fan of it. I'd rather do projections and figure out the actual amount owed. Because the years are so different, there can be times where, okay, based on last year, I'm going to pay X, but then I made way more money this year. So I still end up with a huge bill due in April. Last year was really high. This year, not so much. So if I make these quarterly estimates based on last year's, I end up with this huge refund. Again, we're back to getting interest-free loan to the government, which I'm not a fan. The other way is not officially recommended, but a lot of people do it, where they make no payments, right? And they end up at the end of the year, and the IRS will charge an underpayment penalty for it. And you can get yourself into trouble this way. There can be like forced withholding, some kind of situations which you don't want to be in. But the people, especially small business people, make the conscious decision. Yeah, I know there's going to be a penalty. I'm willing to pay that penalty for the use of the cash during the year. If I pay 8%, which is the current rate, it fluctuates with interest rates and stuff, but around 8%, right? So if I owe 10 grand and with penalty, I now have to pay 10,800, I'll make that trade in exchange for the flexibility of having the cash during the year. If there's something I want to buy, if there's something I want to do with the cash, all this kind of stuff. That's method number 4, which is officially not recommended, but a lot of people do it. So those are the different ways. If you had to pick one, I would go with do the projections and get an accurate payment in so that come April when you actually file, or if you're waiting on K1s or something, September, October sometimes, then and you don't have to worry about paying and you don't have to worry about getting refunds. So yeah, that'd be the way I would go.
Alrighty, so it looks like we have a future tax question review. Someone wants to know, do you think tax rates are likely to increase the next few years, and how should we prepare for that increase?
Yeah, so we just had this election, right? And supposedly in January, Trump's going to be in office again. Now, Trump has talked about what he wants to do with taxes. And basically, it comes down to he wants to make his last tax reform permanent with some modifications. And in that case, tax rates are going to remain the same. The question becomes, if everything goes as planned, will that get through the Congress? Because presidents can say whatever they want, but all tax bills have to start in Congress, be passed by Congress, and then signed by the president into law. The Republicans have a very narrow majority in the House. They've got a slightly larger majority, but still narrow in the Senate. But already there's talk in political circles about the Senate being run by guys who even though the Republicans are not friends with Trump, we'll see. If the Trump plan does not get implemented for whatever reason, then the Tax Cut and Jobs Act is going to revert back to the way it was before 2017, and tax rates will go up. So that's where we are right now. It's very much to be determined with this upcoming administration.
Alrighty. So we have a general question, Neal. Someone wants to know, for someone feeling overwhelmed by taxes, what's the first step you'll recommend to make this process less stressful?
Yeah, so the first step is to get your documents together. And what you're feeling stressed about really dictates what that means. So a lot of people have past year issues, right? So it's like we talked to a client last year. We were talking about current year stuff. Is, oh yeah, by the way, I also owe 100 grand on the last couple of years. Okay, that's good to know. If that's your case, what you want to do is you want to start collecting transcripts. So if you create an account at the IRS, you go to irs.gov, and it says something like, actually, I'll just bring it up here. I think it's get my records or something. Sign into your account, get your tax record. This guy right here. Let's see if I can highlight that. That guy. So there are transcripts of different things that the IRS has on file for you, and it's by social security number. So you create an account. You have to have one of those IDs with the star on it so it can be real ID certified. So if you can do that, it's better than it used to be. It used to be only about half the people could successfully log on, but now it's 80% can successfully log on. If you're able to get into your account that the IRS has for you, then you can download transcripts. And there's different transcripts. There's a tax return transcript, there's a wage and income transcript, there's an account transcript, and there's one more that I'm blanking on, but there's 4. And you can download them back going several years. And if it's older than that, then it's a separate process. But if it's relatively recent, then you can do it. And you start putting those together by year. And you're able to get everything that the IRS has on file for you. So the tax return transcript is going to show you what was filed, on the tax return as far as the IRS is concerned. It does not look like a tax return. It's just a bunch of text with lines and numbers. It maps to a tax return, but it doesn't have all the different things that are on a tax return, all the details. It just has kind of like summary numbers. And so that's thing number 1 is figure out what was filed. The other most important one, wage and income, is what other people filed and the timestamps are wrong, which is super fun. But so the upshot of all that is that if you collect all those transcripts and you're dealing with a past situation, then you can take those and bring them to a professional and you say, okay, here's what I'm dealing with. What can we do? Is it just a matter of paying? And I did some crazy thing where I exempted my whole paycheck and now I owe money. Is that the situation? Or is there some kind of error where it can be fixed? That's always the best situation. But it needs to be done. And there are strategies for dealing with this. So I'm a profit first professional. Profit first is a cash flow management system for small business. And what it amounts to is you set up multiple different bank accounts, and Relay is great for this because you can set up like the 20 or 50 bank accounts all free. Super fantastic. When money comes in, it comes into one account and then you distribute it to other accounts. You can distribute for tax savings. You can distribute for profit. You can distribute for money for you to live on. You're going to distribute for operations expenses. You do all that, and then you know that the money coming out of your operations expenses accounts and everything else is not. And that simplifies the bookkeeping massively because you're categorizing by account rather than categorizing by transaction. So at least you'll have a global understanding of what is happening to the business. In other areas, if you have rental property, you need to be managing that, whether you're doing the management yourself or if you hire a property manager. Most property managers these days will be able to give you a report in terms of profit and expenses, revenue expenses. If you're doing it yourself, you need to be on top of those numbers as far as money coming in, money going out. So yeah, it really comes down to being on top of the numbers, whether it's a past situation or a current situation. But that's where you start. What money is coming in, what money is going out, how are those things categorized? Are they taxable? Are they not taxable? That is the basics that you want to start developing in order to keep organized. Part of the difficulty is that every taxpayer is everybody, and some people are really great at organization, and some people are really not. So if you're one of those people who is not, then that can be a real challenge. And at a certain level, basically, just need to hire somebody in order to do that kind of work for you. If you temperamentally just can't do it, but shorter than that, those are the steps you'd go through personally to keep on top of your numbers.
Would you say this is it depends question?
They're all depends questions, but yes.
Right. Understood. We have a question, Neal, about the flat tax system.
Flat tax, yeah.
Yeah. What's your take on the idea of a flat tax system? Would it simplify things or create more problems?
Both. So it would simplify things and it would create more problems. For flat tax, basically, and there's different versions that have been proposed over the years. Flat is good in that it's simple, right? So it's 10%, it's 15%, whatever the percentage is, it's simple. So like Estonia, I have read, has a 10% flat tax. And basically when you withdraw money from the bank, they just give you 90% of it and that's your tax. It has that allure in that it's simple. We don't have to do all these different things and plan for things. The power of the tax system that we do have is that it caters to your customization and the fact that your life is different from somebody else's life. If you're under that withdrawal system like Estonia has, and you want to withdraw $1,000, they give you 900. It's okay, but what I was going to use it for was not like a business thing. I'm just going to pay to help me do something. It wasn't like a personal hobby kind of thing, or it was just not an income producing event. Depending on your particular numbers, you might end up paying more under a flat tax like that than you would under the income tax that we do have. Then there's the fact that the biggest criticism of flat taxes comes from the left side of the political spectrum in that it is regressive. And what that means is that there's a basic cost of living, right? Everybody's got to pay for food and shelter and energy. Now, how much they pay changes, right? But everybody's got to pay for those in some form or fashion. Either you have rent or you have a mortgage, or even if you own a property free and clear, there's still property taxes, there's still maintenance, there's still utilities, all those kind of things. So if you make $50,000 and you have a family of 4, your cost of living is probably $50,000, and that's just covering the basics. So if you have to pay tax on that at a flat tax, you're artificially raising the cost of all those basic life necessities. Whereas if you are very wealthy and you make $500,000, your basic cost of living might still be $50,000, and the tax on that is irrelevant for your situation because you have all this buffer room. And so that's what they mean by it being regressive, in that in terms of percentage of the cost of basic living, people who make less will end up having a higher net effective rate on their income compared to people who make more. And it's because of that's why we have a graduated tax system, that as you make more, those portions that are higher and higher on the income scale, you actually get taxed more and more along that spectrum. So the first money that you make is tax-free until you hit the standard deduction. Then you pay 10%, then you pay 12%, then you pay 22%, then you pay 24%, then you pay 32, 35, 37. So that graduation, that change in the scale as you go along is there to reflect reality that the cost of living is fixed and significant. So I don't see a flat tax happening in the US because of those issues, but there have been these proposals. I used to be a fan of the fair tax, which was it was a flat tax, but it was a sales tax based. So if you talk to economists, a lot of them will say that the best tax is a consumption based tax. So when you buy stuff to use, then that's the point at which you want to tax something because that is totally discretionary. So if you're super rich and you want to buy a yacht, then you're going to pay a whole boatload of taxes, pun intended, at that point because you're consuming a good, this boat or this yacht into service. And at that point, it becomes a retail sale and you're going to pay a whole bunch of taxes. And the way the fair tax dealt with the regressive nature is that everybody would get a monthly payment equivalent to the tax that would have been paid on the basic standard of living for your family size. So there's some administrative issues with that as the family size is 4 and somebody moved out or we had a baby or we got divorced or all these different kinds of situations that are going to modify that family size. So it's a hassle in that regard. But I think that's probably one of the best tax proposals I've seen over the years. But it's one of those things proposed 20 years ago, something like that, and got a little bit of attention and then went nowhere. I don't anticipate any major changes to the tax system. Even with Trump talking about tariffs, there's no way to charge enough in tariffs to replace the income tax. And the worst possible thing that would happen would be high tariffs and having the current tax system. That's something to watch out for with this upcoming administration. So yeah, overall, I actually think our system is one of the better ones simply because it is so customizable to everybody's situation that you can really tailor things to you rather than being forced to pay according to one size fits all kind of tax policy. We're coming up on the end of the hour. How is the next one a long one or no?
It depends.
Fair enough.
But they just asked, this is a general question. They want to know, can you explain the difference between a tax deduction and a tax credit, which has a big impact on reducing taxes?
Depends on the number. But yeah, so a deduction affects how much income you're being taxed on. So let's just take a business, very simple. Business brings in $100,000. It has expenses of 80. That leaves 20, right? Those are deductions against the revenue of the 100,000. So we're lowering the amount that is subject to tax. And there's all different kinds of deductions. But so the way the math works is you have revenue, you have deductions, and then that creates your taxable income. And then you have your taxes assessed based on that. And after that, you have credits. So what credits are changes to the amount of tax owed after the tax has already been calculated. So let's say I owe $10,000 in taxes, but I've got a few kids that are under the age of 16. So I'm going to get the child tax credit of $2,000 a kid. And so if I've got 3 kids, that's $6,000 worth of credit. So instead of paying the 10, I'm going to pay 10 minus 6. That leaves me with 4. Okay. So deductions hit the income first, then taxes assessed, and then the tax is modified by the credit. And there's different kinds of credits. There's different kinds of deductions. So all that goes into the consideration. As far as which is better, usually credits are going to be better on an impact basis, but that's not always the case. So again, it depends. But most people are semi-okay at deductions, and a lot of people miss the boat entirely when it comes to credits. So the credits everybody knows about are the credits for kids, although there's actually 3 credits for kids. There's the earned income credit, there's the child tax credit, / additional child tax credit, and then there's child care credit for daycare and aftercare and stuff like that. Most people have heard of the credit for electric vehicles and that kind of stuff that was revamped recently by the Inflation Reduction Act. There are other credits on the personal level for residential energy, like if you have solar or if you put in a heat pump or you have an energy audit in your house by your utility company, stuff like that. But there are even more credits than that at the personal level. And then at the business level, there's tons of credits. So there's solar credits, that's a popular one. There's credits for providing low-income housing units. There's credits for hiring people to work that the government wants to favor, the work opportunity credit. Form 3800 has a whole list in the form for different kinds of credits. If you run a restaurant and you cover your employees' Social Security payments, there's credit for that. And then in most cases, those are going to pass through to the owners and then get deducted at the personal level on the personal tax return. Yeah, there's all kinds of stuff out there, and some credits are transferable and saleable and some are not. The ones that are transferable, there's a whole marketplace out there, but you have to be talking big dollars at that point for that to work. Usually that's if you owe 6 figures in taxes and up, that's where the credit marketplace starts to kick in. But yeah, so that's the difference between the two. And the bottom line is that which is better, it depends on your situation, depends on what you have going on, depends on the numbers involved. Take both. That's really the answer. Take deductions to minimize the tax assessed, and then take credits to minimize the tax after it's assessed. So that's the upshot. All right. So that brings us close to the end. I always like to leave people with next steps. Yeah, go to taxsherpa.com/explorer or scan the QR code there, and that will take you to sign up for our free group. It's totally free. And you'll get notifications about this show. You'll get access to a lot of resources on our voting portal. We've had a bunch of people lately who needed our partnership blueprint. We have the 13 questions that you need to answer before going into partnership with somebody. And that's a free resource in the Explorers group. There's stuff being added all the time. So I'm working on an S Corporation workshop that is going to be coming up, and that's going to be free for all of our explorers. And you'll have access to things like the starter plan, which will be super cheap for explorers, free for our navigators, which is our premium group. And fundamentally, if you want to buy any of the things that do have a cost in the explorers, it's better just to join the navigators and just get it all for free. So that's the incentive to join the navigators, along with weekly calls that we do that's private and not in this streaming format. But yeah, become an explorer and you'll be up to date with all of the things that we have going on in the tax sherpa world. You'll be notified with workshops, learning modules, we have forum, all that kind of stuff. So it's a good time. I guess that does it for this week. So we'll do this all again, actually. Next week is Thanksgiving. So we will be off here at Tax Sherpa starting Wednesday of next week, but Tuesday we'll still be in the office. So we will have a show next week, same time, same channel, and we'll see you then. So thanks, everybody. Great to see everybody out here. And if you're looking for the replay, YouTube will have its own replay, but then later on, as we edit and trim down everything, it will all post those as well. See you next time.
Alrighty.
It's fine.